You guys shouldn't be too mad at me. Cowboys finally won a playoff game. Congratulations. Very proud of you guys. Hang in there. So, yeah, thanks for scheduling me on one of the most volatile days of the history of the markets. Good timing. So, not everybody sits around and watches Jay Powell conferences like I do. So I would basically sum up today's statement as essentially, this is fine. He just spent a lot of energy trying to reassure us that the banking industry is totally fine. Nothing to see here. I had a lot of flashbacks to 2007 and 2008 when I was at Wachovia. I was on the trading desk and I ran interest rate derivatives for the West Coast. And I distinctly remember Bear Stearns hedge fund going under summer '07, which was like a year and a half before anybody else really felt the pain, right? But our traders told us, hey, a credit crisis is the worst kind of crisis. This is a big deal, right? CMBS totally froze up, but not much else changed. We just felt like everything's slowing down, things were going south. Springtime '08, Bear Stearns, the firm, goes under, and we're like, uh-oh, this is weird, right? Like a bank just failed, right? Sound familiar? Fed kept saying everything's fine. It's isolated. We've got this under control. I look back on that. Bear Stearns needed $25 billion to be bailed out. It feels like a quaint number these days. Just 25 billion, just cut them a check, whatever, like, right? But at the time, there was still this concept of like, and fear of moral hazard. If we bail them out, who's the next, right? We can't do that. We got to send a message. Probably sometime mid-September '08, it was a Monday. I talked to one of my best friends who ran all of trading for Wachovia interest rate team. And I said, because our stock had come down. It was like 42 bucks a share, 29 bucks a share. And I was like, how bad is it? We had replaced the CEO a few months prior, but we replaced it with a guy who was connected at Goldman. And he was connected with the Treasury, and so we thought, okay, there's definitely some stuff going on behind the scenes. We're gonna be okay. And I said, how bad is it? And he said, we will be out of business by this weekend. And I thought he was messing with me. So I'm like, yeah, right, no, seriously. And he's like, we can't trade with anybody. No one will trade with us. We have no ability to hedge any of our risk right now whatsoever. The entire bank is fluctuating at the whims of the market, and we have no ability to manage this risk anymore. He said, we'll be out of business by this weekend. He was wrong. We made it till Saturday morning. Friday, there was a run on the bank. Saturday, that run continued. Anybody who had deposits at Wachovia took them out. Anybody who had an undrawn line drew on it and deposited somewhere else. We were out of business Saturday morning. Sunday, we got sold to Citi for $1 a share, which was like the blind leading the blind. They were just as bad a shape as we were. The Fed came in and was like, no, we can't allow that. They're terrible. We're gonna have to bail both of you out. Here's Wells, go talk to Wells. We got sold for $10 a share. Monday, woke up a Wells Fargo employee. It happened just that fast. And so when SVB started happening, I'd send a Slack to my team, because on Wednesday night is really what kicked it off. They had to come out and they had to raise $2 billion. Right? Again, a quaint number in the grand scheme of things, not a big number. They had to raise $2 billion. But it caused everybody in the market to say, why? Why are you suddenly having to raise money right now? And they started digging in a little bit, and they realized, wait a minute, you guys bought all these treasuries, 10-year treasuries, when the yield was 1.5%, and you're upside down on them. You've lost a lot of money on those bond holdings. Up until this point, SVB had not had to recognize those losses, because you're allowed to carry it forward as a mark-to-market loss, right? So it's just, yes, it's supposed to be worth 100, it's only worth 80, but I haven't actually sold it, so I haven't recognized the loss. Might see some parallels with real estate, I don't know. It's not my job to tell anybody that. But it starts ringing true about like what's going on that we haven't actually recognized yet. They go to raise the $2 billion bucks. Everybody pulls back and says no. And not only are we not going to give you $2 billion, we're going to start investigating this. We're going to start looking at the math here. And the market started running the math on SVB. Turned out they were upside down. They were negative equity if they were forced to sell their treasury holdings. Now they weren't at that moment. They didn't have to sell all of them, right? They were going to lose a couple $1 billion. It wasn't the end of the world, but the market didn't care. The market said, but if you had to, you would be upside down. You would cease to exist as a bank. So I sent a message out to my team and said, I've seen this play before. Yesterday the stock price went from 268 to 106 in a couple hours, right? Halted trading several times. Then the run on the bank started. Because all their friends who had made them rich over the years, the VCs and the Ps who were artificially propping up the value of the tech companies, said, you know what? You guys should probably take your money out of that bank. Because if they go under, you're going to lose those deposits. FDIC is only up to 250 grand. So guess what everybody did? They ran and took their money out. That exacerbated the problem. That took me right back to the Wachovia days, right? I was like, that's when we ceased to exist in just a matter of hours. We went under just that quick. They had, I think it was $42 billion in deposits withdrawn on Thursday. Friday morning I sent that Slack out and I said, they'll probably get to the other side of this, but there is some non-zero chance that they don't survive this and they cease to be a bank by Monday. 4 hours later they were seized. They stopped existing as a bank, right? And so what I would suggest to people is when it comes to the banking industry, it can happen very fast to the first few players, just like it happened to Bear Stearns. Keep in mind, just because Powell is trying to reassure us today everything's fine, doesn't mean it is. It took 18 months from the first Bear Stearns hedge fund going under till the rest of the banking industry collapsed. So I do not buy the story that everything is fine today. I think it could be fine. 2 weeks in is too early to say it is fine. And so be mindful of that. And I worry personally in the commercial real estate industry is what happens to lending appetite that felt like it was finally starting to thaw a little bit. Do they all pull back again? Do they suddenly take that defensive posture again just as they were starting to come out and they're like, nope, we got to pull back, right? Now we'll see. You know, brokers who are the eternal optimists assure me, no, all these banks are going to be lending aggressively, we're good to go. But we'll see if they actually deliver a closing. I'm not convinced that in 2 weeks the news got passed down from the top of the house to the individual banker. We are no longer in the lending business right now. It is time for us to take a defensive posture. Let's get on the other side of this. Give it a couple months. Let's see what happens. But until then, just because J Money says this is fine doesn't tell me it is fine. Okay? Be aware of that as you're considering your financing options. Be aware of that as you're considering the selling options. That there is something out there totally outside of your control that could get worse over the next sort of 6 to 12 months. I personally don't believe this is a replay of 2008 because banks are so much better capitalized than they were back then. 2008 was a house of cards. I was at Wachovia. Our CMBS guy was doing 100% LTV deals, non-recourse at like swaps plus 85, 90 basis points, right? It was insanity. Banks are still way more conservative now, and the regulations did a good job, especially the larger banks, of protecting them, right? So they are well capitalized. I don't see a total implosion. Doesn't mean we can't have a cooling off, and doesn't mean that there aren't some smaller banks who don't play by the same regs who aren't going to be exposed in the coming months, right? So with that silver lining, let's talk about today's meeting. Oh, you're already quitting, huh? That was all it took? You're just like, you're like, I didn't invite this guy. Don't blame me. I'm getting out of here. Alrighty, so hike today, 25 basis points, okay? 2 weeks ago, the market was pretty certain it was going to be 50 basis points. Today ended up being 25 basis points. The market had said it was like an 85% chance of 25. I thought it was more like 50-50. Normally, when the market and the Fed disagree, the Fed will come out and massage the statements. They'll send signals. But when you get within a week of a Fed meeting, they're not allowed to say anything. So they had no ability to massage the message. So I actually thought it was like a coin toss. I did think it would be 25 basis points, but for different reasons. Mostly, my thought was, if they pause, the market might say, you know what? Does that mean all that massive intervention you just undertook wasn't enough? What do you guys know behind the scenes that we don't know? How much worse is it going to be? And he was almost forced to hike 25 basis points just so he could tell everybody it's fine. It's tough to say everything's fine if I'm also pausing, right? I also think he wanted to expend a lot of energy convincing everybody there are two different things that we are tackling right now as an FOMC. Number one is financial stability, and that's got nothing to do with hiking or cutting interest rates. That financial stability is around quantitative tightening and quantitative easing, the size of the balance sheet, okay? So you guys might have heard that the Fed's balance sheet ballooned to $9 trillion, right? It got up to $4.5 trillion post-financial crisis. Then after COVID, it went up to $9 trillion. It's crazy, right? And there's no way we're ever getting back down to zero. I see no scenario where we can get back down to zero. Every time the Fed shrinks the balance sheet by about $700 billion, everything seizes up and everything breaks. And that's what we're seeing right now. So I think what he's trying to convince everybody is that tool is related to financial stability. That's got nothing to do with me hiking rates today. Hiking rates is related to controlling inflation, and we still have some work to do on controlling inflation. I was surprised. I thought he was a little bit more dovish than I expected, because one of the things that he said, and this was totally unseen, I did not know that he was going to say this, there's no whispers about this. He spent a lot of time talking about how credit conditions were going to tighten. And that took me back to my Wachovia experiment, and like, what is he signaling to us right now that's going on in the banking industry? Are they going to get even that much more tight with lending standards than they have been? Because he said repeatedly, over and over again, credit conditions are going to tighten. We haven't seen it yet show up in the indices that we track. It's going to happen. And it was like a signal that that's going to substitute for other rate hikes. We can stop now because that's going to do the rest of the work for us, right? Which I actually interpret as a pretty reasonable conclusion from the Fed chair, because they're normally doing backward-looking stuff. This is at least acknowledging things are going to tighten up. These regional banks are going to tighten up. It's going to slow things down. It's happening. And that means that will replace 1 or 2 or 3 hikes, right? And allow us to sort of grind slower into this soft landing that they're hoping to achieve, which I think is totally out of question. May 3rd is about a 45% chance of a hike. I think that is still maybe a little bit high. I think today might have been the last hike. The reason he couldn't pause today was because the Fed has no track record of pausing and then starting again. So even if he came out and said, you know what, guys, financial instability, banking crisis, we don't want to pile on, so we're just going to press pause today. May 3rd is definitely on the table. I think the market would have said, no way, you're full of it. It's never happened that way. I don't believe you this time. You're now on the clock for rate cuts. And so he's like trying to limp along at 25 basis points a pop as long as he can, and just sort of stalling the pause, because he knows once he pauses, they're on the clock for the cuts, right? And he doesn't want that yet, because it could bring back expectations for inflation to go back up, and it could ease financial conditions. It actually makes everybody's life a little bit easier when they finally pause, right? He doesn't want that yet. He still wants to be applying the brakes, and he's not able to do that if everybody's thinking about how rates are going to be slash and burn in the second half of the year. Notice that the first cut is being priced in June. So the market's saying there's still a pretty good chance that they're going to hike again on May 3rd, but then they're actually going to start cutting on June. And I think that's too early, but that just gives you an idea of how the market is interpreting this, that you should have stopped, you're going to keep hiking, you're going to slash and burn on the backside of this. It's just like every other cycle we've ever seen with you guys. That number is a little stale there. The post-FOMC, now the market's got Fed funds 4% at year end, 3% at year end 2024. So one way or another, we're getting closer to the point where they start cutting interest rates. So when we track volatility and interest rates, we don't track the VIX, which is what a lot of people track. That's equities. We track the MOVE index, which is interest rate volatility. And as you can see, SVB was the second most volatile period on record. Only other time was Lehman going under, right? It was insanity last week. So last Tuesday, 2-year Treasury was down 100 basis points in a couple days. And so my thought was cap prices are going to be way down. We need to call all these banks that we buy caps from and figure out where their pricing is. And then we need to call every client who has a cap that they might need to buy this year and at least put it in front of them to say, prices have fallen by half. Here's the number if you want to move forward, right? The first bank that picked up the phone said, actually, our price is higher than it was a week ago. And I said, that can't be true. Rates are down 100 basis points. And they said, sorry, volatility's up. It's out of control. It's higher. I said, to heck with you. I didn't say that. I said something else, but I hung up. It's like if I was at an Eagles game, right, and playing the Cowboys. You guys could probably picture it, right? So I hung up and I said, to heck with you, I'm calling the next guy. Called the next guy, same thing, hang up. Called the next guy, he said, we're not selling caps today. We're out of the cap business today. We won't sell anybody a cap. I won't give you a number. We found a couple more banks like that. We found 2 banks that would transact last Tuesday, only 2, SMBC and Wells Fargo. And both of them self-insured. They were not able to hedge themselves in the market, and so they just charged a fortune and figured, I'll self-insure until markets calm down a little bit, then I'll go hedge myself at that point, because I've charged you guys so much that I'm comfortable I'll be able to protect myself. They're the only 2 banks that would quote last week. By Friday, it had returned a little bit to normal. We could still get numbers. The numbers are terrible. They're way too high relative to where rates are and where expectations are, but at least you can get one if you have to. So imagine you've got a Freddie cap maturing, you have to buy one, you can get one. Last Tuesday, that was kind of in question. So this discount window, just in case anybody doesn't follow this as closely as I do, a discount window is basically when you go to, if you're a bank, you can go to the Fed and you can borrow money. Okay? They try to avoid this because it's a signal that they have some kind of weakness. So they really try to avoid doing it. That's why you can see it's usually 0, right? Banks avoid this because it's a signal to the market that something's wrong with them. So they avoid this. If you go back to the financial crisis, Wells Fargo was actually forced by the Fed to borrow from this window to lay cover fire for the other banks so that nobody stuck out like a sore thumb. And Wells argued and said, I don't want to borrow. And the Fed said, too bad, you will be borrowing $25 billion from us, one way or another. Go park it somewhere, but you're taking the money because I need you to help cover for the other guys who actually need it, right? So most of the time, nothing happens. They open up this window. And what they said was, banks like SVB, your Treasury holdings, your MBS holdings, those values that have dropped from $100 to $75 or $80, instead of being forced to sell and recognize those losses, post them as collateral to us, and I'll give you cash for the par amount of the bond. Not what it's worth today, not the $80. I'll give you $100, okay? That way you don't have to sell it. You just give it to me and I'll give you back cash. You now have liquidity, right? Single biggest draw ever on record, more than the financial crisis, happened last week. That's why I'm like, I don't know that this is nothing. This makes me nervous. The next number comes out tomorrow. If that number plunges, that's a good sign. It's like, hey, okay, maybe this is okay. Maybe banks are just doing it out of precautionary measure, and we're going to be okay. If that number is still up there or higher, it tells me something's up. These banks have something going on behind the scenes, and they're borrowing from the Fed as fast as they can. And that's a liquidity issue, okay? So tomorrow afternoon, we usually get the numbers. It'll be interesting to see what this comes out at. More than 2008. Think about that for a moment. This is not nothing, okay? And the other thing I like to point out to people is I've never seen a market reaction as violent as this one that turned out to be nothing. I can't remember a time when the market puked like this for 2 or 3 weeks, banks started failing, and a couple months later we're like, oh, you know what, we kind of overreacted on that one. That's our bad. Sorry about that, guys. Everything's fine. Sorry, totally overdid it. It doesn't work that way. No real good leading indicator here that this was going to be an issue. Here's the Fed's own stress index for banks. Everything's fine. Nothing to see here, right? If you go back to 2008, you could at least see some pressure ahead of time. This time around, nothing, right? Meanwhile, they totally dropped the ball. When they're regulating these guys, they knew everything that was going on. Auditors had just signed off on SVB, something like 10 days prior, right? Like, what is going on here? Feels very reminiscent to me of 2008. I met with another company yesterday, and they said this guy had actually written a paper about the S&L crisis of the late 80s, which I don't really know anything about. You guys might, because that was the last time the Cowboys were good. But that's how you got through the late 80s, right? But he thought there was more parallels with the S&L crisis than with the financial crisis of 2008, right? And so it's just something to keep in mind, but it's not good news. It's not nothing. Before all this happened, recession odds were surging pretty dramatically. right? We're up over 50, 60% by most measures. That's usually the threshold needed to trigger a recession. You don't need to get to 100%. That happens after they've already declared it. This is more like a leading indicator. Once you hit 50%, it kind of means it's going to happen. So one of my biggest frustrations with the current Fed is they keep relying on these backward-looking things to make policy decisions about what's going to happen going forward. This leading indicator index is really, really good at predicting recessions, and it is deeply negative right now. It suggests very strongly there will be a recession, and this is using things that the market agrees are forward-looking rather than backward-looking, right? So you can see over there on the far right, it's dropped. This is pre-SVB. This is not because the banking crisis. That's going to just exacerbate that. It was happening anyway. The other big signal is the inverted yield curve. So I talked to you guys about this last year. Anytime the yield curve inverts, we have a recession. You can have a recession without an inversion, but when you have an inversion, we've never not had a recession, ever. And so what that means is long-term rates are below short-term rates. 10-year Treasury is below the 2-year Treasury. And what that means is the market thinks rates are going to be crashing shortly, right? That the 10-year Treasury at 3 or 3.5 is going to feel awesome a couple years from now when rates are back at 0, okay? So what you can see there is it doesn't do a great job of leading it with any certain amount of certainty around time. Kind of the average is sort of 18-ish months. It inverted April 1 of last year, so we're coming up on the 1-year mark. And you hear a lot of economists talk about sort of the fall is when a recession, that would be around 18 months, right? It kind of ties out. The steepness of the inversion is as deep as it's been in 40 years. There's really no good correlation between the steepness of the inversion and the subsequent recession that happens afterward, okay? Where there is a good correlation is how long are we inverted? And Wells did a great piece on this last year. And what they found was, if you've been inverted for more than a year, the recession that follows is worse than normal. April 1, right? Like it's right around the corner. So this would tell us it's coming. This is going to be painful when we get there. I've got a lot of meetings the last couple days, and I've met with a lot of people like, let's just kind of get it over with. I'd rather just break everything right now and start over than for this to drag on for another 12 months, right? And this sort of banking crisis, the cracks that we're seeing in the system might actually end up doing that. This tells me high likelihood that we're gonna have a recession. Any hopes of a soft landing, I think, are gone. Sometimes people say, well, did it predict COVID? Curve actually inverted prior to COVID. Sometimes we forget that the Fed was cutting rates prior to COVID, right? We were already actually heading for a recession prior to COVID. It's like, no, obviously it can't predict a pandemic, it didn't predict this banking crisis. What an inverted curve tells you is the market believes the financial system is so strained, it can't withstand a shock. The shock this time is just higher interest rates, right? Before it's been COVID, before that it's been a financial crisis. There are different shocks to the system. It just says we're not going to be able to withstand it, whatever it ends up being. Real rates. So this is one of my big misses from a year ago. I think I probably talked to you guys about this last year. It was March of last year. I'm doing a ULI Capital Markets Symposium, and it's me and the Charlotte Fed economist on a panel, and we're kind of going back and forth. And I was skeptical that the Fed could hike rates 3% in 1 year. I was like, I don't think that they're going to apply the brakes that hard in 1 year. They've only done 3% once or twice in history. That's not their MO. And he said, here's what I think you're missing. Until real rates are positive, we don't believe that we're applying the brakes because we still have negative rates, which is still very accommodative. And when you hear the word real, when you're talking about real rates, it just means adjusted for inflation. Take the number that you're reading in the Wall Street Journal minus wherever inflation is equals real rates. So using a pretty simple example, Fed funds was at 4.7, core PCE was at 4.7, real rates were at 0. It's basically free to borrow, right? For the last year, it's been negative. Even though they've been hiking tremendously, it's been negative. From the Fed's perspective, that means they have not yet begun applying the brakes. That was what he was saying to me. And so he kind of popped me in the nose on that, and I was like, holy cow, they're gonna hike more than I realize, because we are really far away from positive real rates. Now, Powell won't put a number on it, but sort of taking what we think he's implying is somewhere between 1 and 1.5% real rates is what he wants. That's him applying the brakes, okay? So very simplistically at the bottom, what I did was say, okay, give me what the Fed is projecting at year end, 3.5%. That's what they think core PCE is going to be at year end, 3.5%. Add 1.5 onto that. I want 1.5% real rates. What do I get? 5%. Where are we today? 5%. Where do they talk about pausing? 5%, right? It's a very simplistic calculation, but it gives you a sense of how they're managing this right now. This 1.5% is them applying the brakes. If it's negative, they're still stepping on the gas. As you stretch out to the next couple of years and they predict inflation will come down, it implies they'll be able to cut rates and still maintain that 1.5% number. Now, if we have a banking crisis, all bets are off. This will get thrown out. But if we're strictly focused on inflation, you tell me where inflation is going to be at the end of 2024, I can give you a really good sense of where Fed funds will probably be, right? So here's my favorite graph, financial conditions. All the Fed actions are the inputs. This is the output. This is what the Fed uses. They use this. Powell references it in every conference, press conference he does. Gray horizontal dash line is kind of considered the Mendoza line. Anything below that is them pressing the gas pedal. Anything above that is them applying the brakes, right? And then the yellow line is kind of the recession line. So as you can see there, 2022, we were the most accommodative ever. And I would love to take a lot of credit for Pensford having its best year ever in 2022, but it wasn't me, right? I had insane tailwinds at our backs, right? They start hiking, and this is what that Fed economist was telling me. We're not on the brakes yet. Until we get above that gray line, we have not touched the brakes. We're just letting off the gas. And so from the Fed's perspective, they have just now started to get into pressing the brakes. Okay, now the banking system's starting to collapse, puts all that into question, but from their perspective, this is really important, they want to actually keep applying the brakes to make sure that they bring down inflation. And that was one thing I was really missing a year ago, was that's their mentality. All of that run up and things were getting tighter and tighter is not applying the brakes, it's letting off the gas pedal, and that's different. If they're doing a great job of anything, it's winning the war on expectations. And inflation expectations are probably the thing that Powell is most concerned about, probably more so than actual inflation data that keeps coming out. Expectations are what lead to inflation becoming entrenched. If we all believe inflation is going to keep falling over the next couple years, it's not becoming entrenched, it's not becoming part of our psychology, and they're winning that war, and they can eventually start cutting interest rates. If we all start believing inflation is going to be at 6% forever for the rest of our lives, now they're losing the war on inflation. So part of the reason I think he had to hike today was say, I can't yet allow that to start creeping back up. If I let off too soon, rates just now getting positive, that might start creeping back up. Look how much ground he has gained since the first hike. That's the peak, is that first hike. And it's come down to 4%, right? He doesn't want to give up that ground. That's been hard fought ground over the last year. He doesn't want to throw in the towel yet. We have a banking crisis, that's probably going to collapse because everyone's going to feel terrible about everything. He won't have to worry about managing this anymore. Absent that, he still has to send signals. He's focused on inflation. He even said at some point today on the press conference, we will keep hiking more than you guys think if we need to, right? Barring a total collapse, we're going to keep hiking if we have to. Today was the first signals he sent that he actually thinks that inflation is coming under control. The actual inflation has been a little bit more stubborn than he would have liked. Now CPI is actually improved quite a bit. And I feel like that this improvement maybe doesn't get enough play in the media. June of last year was 9.1, that was the peak, right? We just got 6% 2 weeks ago. So in 9 months, we improved from 9.1 to 6. It's not where we want it to be. It's not the worst improvement in the world either, right? Core PCE, however, which is what the Fed likes to use, strips out things like oil. Saw oil finish today below 70 bucks a barrel, right? A lot of CPI dropping is oil. If you take that out and say, yeah, I'm not going to give you benefit of that, Let me look at other stuff. Let me look at services. It's not quite so rosy. And so this is the thing that's probably keeping him up at night right now, because he's like, it is really stubborn. They're forecasting that core PCE is going to fall 1.2% between now and year end, and it has fallen 0.8% in the last 12 months. That's a big change. I'm not sure that they're going to be able to pull that off. If that ends up being stubborn, they'll keep hiking. I think that's what he's looking at right now. He thinks it's coming down, and I would argue whether we hike another 25 basis points or not is kind of irrelevant. What we should be really focused on now is time, giving it time, right? When he hiked a year ago, he said this is going to take 12 to 18 months before it even shows up in the numbers. It's improved. It has come down. And I believe a lot of it's come down because supply chains have largely resolved themselves. Yes, there are still weird things out there like autos, but by and large, most supply chain measures are back to pre-COVID levels, right? Retailers are actually starting to stockpile inventory. It's actually, I think it's going to roll over pretty quickly. It's going to get ugly pretty quickly. But core PCE still has a little ways to go. And he's banking on this thing cooling off pretty quickly over the next 9 months. And if it doesn't, he's going to be boxed into a corner because people are going to be saying, what are you going to do about inflation? The other number that jumped out at me today, they're still calling for unemployment to climb to 4.5%. That's about a percent increase. That's just under 1.5 million Americans lose their job, right? We're still gaining 300,000 jobs at the last report. I'm not sure how we achieve that based on what they're currently predicting. But he's saying we're going to drive up unemployment. We're willing to tolerate a couple million Americans losing their job in order to get this under control, because the price of this not working, getting under control, is worse than the cost of 1.5, 2 million Americans losing their job. Now this graph is terrible for a room like this because you guys can't see any of this stuff, so I apologize. I'm sure you guys are sending out the slides. So what it's meant to reflect is the amount of excess savings that were ramped up post-COVID. That's what that starting point is. It's like there was no excess savings prior to COVID. COVID hits, everybody starts staying at home, helicopter money gets dropped on top of everybody. Nobody really spends their money, right? Way more savings than normal, to the tune of $2.1 trillion was stored up in the economy, just waiting to be unleashed. And then it started getting spent. And there's a green line in here that's sort of the aggregate of all of this, and it's coming back down. We are just about down to the point where we have spent all the excess savings. And so when you look at this consumer spending, which is 2/3 of GDP, it suggests it's going to slow down pretty considerably over the course of this year. All this money has been spent, but guess what? People haven't changed their spending habits. They just started using credit card debt. And if you look at the credit card graphs, they're all surging. So people are still spending their money, they just haven't changed their spending habits, and now they switch to credit cards, and guess what? Interest rates are up way more than they were a year ago. And now all of a sudden they're paying way more on that. It's starting to feel like that's setting the stage for things to roll over pretty quickly this year. And I think what Powell was doing today was trying to acknowledge this could change a lot over the next 9 months, and we need to be mindful of that as the Fed. We can't just keep hiking 25 basis points based on backward-looking metrics. Again, another terrible graph for this setting, but what it shows is core PCE leading into a pause. So this is inflation leading into a pause. Core PCE right now is 4.7, okay? We went back at the last 10 cycles, going back to 1969. Core PCE inflation is not usually 2% when they pause. They pause before then and allow it to just keep coming down. So just because we haven't gotten there yet doesn't mean that they can't stop. The one caveat is the last 4 cycles, it's been below 3 before they paused. And we're at 4.7. 3 is a long way away. So this makes me a touch nervous that if they end up stopping and inflation doesn't come down, we could be dealing with persistent inflation. And that sets the stage for what they're trying to avoid is a repeat of the 70s, right? That's the situation they're trying to avoid. Is in the 70s, the Fed was not asleep at the wheel. The Fed did a good job of hiking when inflation ramped up. The problem was they stopped too soon. When inflation came back down, first time, got back down to 3%, and they stopped. because unemployment had surged. The second time around, got down to 5% and they stopped. It took 20 years from the time it crossed 2% till the time it was back below 2%. Powell's trying to avoid that. If we aren't below 3 when they pause, it makes me a touch nervous that we're not going to see it keep going down. What happens if like the first 3 or 4% is the easiest and the last 2 or 3% is the most stubborn inflation, right? He's got to deal with all these dynamics on top of a potential banking crisis. The labor market is really becoming my pet peeve of this entire cycle, because all I keep hearing about is how incredibly resilient the job market is. And first thing I would say is I'm not arguing that the job market is weak. I'm arguing it's not as strong as people are claiming it to be. There is really no precedent for us losing jobs month over month in the first year of a tightening cycle. That's not how it works. It takes a long time for that to happen. So up here we've got this graph like, okay, first time we had a negative job print, on average 1.7 years, right? There's a couple oddballs in there that are really extensions of the late 70s, early 80s that I kind of don't count, but we put them in there just because people think we're monkeying with the data. But really it's like that was just an extension of one long tightening cycle, right? He paused for 6 months, started again, they had job losses pretty quickly. In general, it's more like 2 years. And in fact, what we found is you usually don't start losing jobs until after the Fed has started cutting. So imagine a scenario that feels totally realistic where we're actually gaining jobs all year. They start cutting at the end of the year. Job losses don't actually start showing up until next year. That would not be weird. That's actually how it's happened every other time. And yet we keep behaving as if it's weird that we haven't turned negative on jobs yet. On average, we're gaining 203,000 jobs the 6 months leading into a pause. Why are we suddenly this time expecting that we should have negative job prints leading into a pause? The one that really gets me is this JOLTS report. Been doing this for 20 years. Never heard anybody talk about a JOLTS report until 3 months ago. And all of a sudden the Fed's apparently using it to dictate monetary policy. So the JOLTS report is, how many job openings are there? I don't know if you guys have seen it. That's what the graph on the left is. And Powell keeps referencing it. He actually didn't bring it up today, thank God. But it's like there's 2 job openings for every unemployed American. Job market is insanely tight. It's like, yeah, but how hard is it to keep a job opening online right now? If you've ever put a job posting up online in the last couple of years, it's free. Right? Like, it costs nothing. I probably have job openings I don't even remember putting up there, right? And they're counting that as if it's this job opening. Or the last couple of years, it's been really hard to get somebody. So you leave it up there and just say, if I get somebody amazing walking through the door, I'm going to take them. Otherwise, I'm not putting any energy into this, right? It also doesn't measure the quality of the jobs. So the people at SVB who are going to lose their job, do they have 2 openings for every one of their positions? Or are we suggesting they can get a bartending job if they're looking for a career change, right? It doesn't say anything about the quality of the job. It just says there's a posting about it. I'm like, what does that got to do with Fed monetary policy? ZipRecruiter CEO 3 weeks ago came out with their earnings and said, we are seeing a sizable downshift in the labor market. The intensity of the job searches, people pulling these job postings. He said there's a, quote, sizable spike in job seeker activity. And he said on this earnings call that they are a leading indicator for the labor market. He said, I don't buy anything that I'm seeing in the labor data. I'm telling you behind the scenes, we see stuff before you guys do. It's bad. And it started shifting 3 to 6 months ago. Their stock price fell by 30% in a couple days, right? These are the guys who are in this business. Like, it is slowing down. And we don't need to be at 0 for it to be a recessionary signal. If we don't get 150,000 jobs in a month, it's a contraction, because that means it's not keeping pace with population growth. 150 is the Mendoza line for jobs, not 0, right? But it's not just ZipRecruiter. LinkedIn said the same thing. When we look across all these different hirings by company size, it's plunged. Well, guess what? Bartender jobs probably not posting on LinkedIn. Most professional companies are posting on LinkedIn, and it's fallen off a cliff. Like, this is happening. I own a software company. We could not hire engineers to save our lives for the last couple years. Last summer, it started thawing out, and now we have our pick of the litter. We lost on a young woman who had less than 6 weeks of experience out of college. She had gotten hired and immediately laid off, and we found her through a recruiter, and she was hoping for 80 grand a year. We had been searching for somebody for months. We had swung and missed for months. I said, and she crushed the interview, she crushed all the tests. I said, offer her 90. Let's just get her in. I think she's a superstar. They called us back a couple days later and said somebody hired her for 125. 6 weeks, not even 6, 4 weeks. She'd been out of school for 6 weeks. 4 of those were she was employed, right? And I said, we're out. We're not doing this anymore, right? We don't have that problem now. We have no problems lining up interviews with engineers. So I think that this is going to change dramatically over the course of this year. Well, here's what James is hoping for. When you hike rates 5% in a year, stuff breaks, right? Traditionally, once the Fed pauses, they're on the clock, and they are cutting rates within about 9 months on average. They had that one cycle where they held on for 14 months. Aside from that, you're looking at really 7 months or less. That's why the market's saying, you know what? If today was the last day, you're cutting before year end. If May's the last day, you're still probably cutting before year end, right? The other thing I'd point out is, look how sharp the drop is. It falls off a cliff. We don't have a good track record of cutting 50 basis points, 100 basis points, and stopping. That's not how it works. We overdo it on the way up, hang out, realize we broke everything, slash and burn, start cycle over again. And it feels like we've done that again this time. And what I was hoping for, I think I probably said this last time when I was here, was I was hoping we would get to a point where they would level off, give it some time, and then back out 50 basis points, 75 basis points. It's the only successful soft landing they've ever had on the far left there between 5.1 and 7.6, 94, 95. They got to a point, they backed out 75 basis points, and they let it run for a couple years. Then they started hiking again and broke. That's the only time they've ever had a soft landing. We're not going to be able to do that this time. Unless they suddenly, in the next couple months, say, you know what, we're backing out 75 basis points and then letting it run its course and see what happens, we're going to probably see a slash and burn again. The day of the last hike, that's the y-axis, 0 over there. The day of the last hike, the dashed lines are, what does the market think rates are going to do? That's a forward curve on the day of the last hike. What does the market think rates are going to do? Basically flat for the next 3 years. Whenever they pause, flat for the next 3 years. The solid lines are what actually ends up happening. Like clockwork, within about a year, the bottom falls out. They pause, everybody thinks, you know what, this time's different. They're going to be able to keep rates at 5% this time for the next 3 years. They're going to really win the war on inflation. Something happens, the system breaks, the bottom falls out, and they're cutting pretty aggressively within the next 12 months. So I disagree with the market that the cuts are coming in June unless the banking crisis heats up. But I do think by year end or start of next year, they're cutting, and it will be the slash and burn variety. I don't think they'll be able to just like back out 50 basis points and reevaluate. Oh, this one's a fun one for me. So cap costs continue to go up. Whenever the volatility settles, it should be good news for caps. With rates being down 100 basis points or 75 basis points, it should be good news for caps once we get rid of the volatility. We are still to the left of that gray bar, which is the pause, right? There is some chance that was today. Once you get to the pause, within 3 months, the bottom falls out of cap prices. They drop 50%. And I suspect there's a lot of people in this room who have a cap, either extension coming up or replacement due. There is some chance that if you have a cap coming due in, let's say, the fall, that you will benefit from this falling off a cliff in the next 3 to 6 months. It's probably not today, but there is a window where this is going to happen. And it happens for 2 reasons. Number one is rate expectations. Once you pause, you're on the clock for the cuts. Rates are coming down, right? Well, if they're coming down, the cap doesn't cost as much, it's not going to provide as much protection. The other reason is volatility. Right now, traders are saying, yeah, I don't think we're getting to 6. A year ago, I didn't think we were getting to 5 or 4, right? I have to charge you something just in case we do get to 6, right? November 2021, Fed said we were not hiking at all. Now they've hiked 5% in 12 months. If you're a trader, how do you hedge that risk? How do you charge you guys for a cap? So they're like, you know what, I got to do it. I don't think it's going to happen, but I've been wrong the last 12 months, so I'm going to charge you something just in case. Once you get on the other side of that and they pause, it takes that off the table. 6% is not happening. Now we know they're done. They have finally leveled off. We can now say, I don't have to charge you for 6%. I don't have to charge you for 7%. And the cap cost comes way down, right? So at some point, these cap costs will plunge. It's just a matter of when do we pause and what happens after that. Same kind of thing with the 10-year Treasury. You can see that the market sort of is implying sort of 3.5% 10-year Treasury for the next couple years, just like the forward curve. It's going to be flat. It ends up not being, the bottom falls out, right? So that historical average on the bottom there shows you 10-year Treasury is very likely going to end up at 2% or less at some point during the next downturn, right? I've been saying I think it would finish this year pre-SVB, it would finish this year closer to 3 than to 4, because the market's going to start pricing that recession that I believe that the yield curve is telling us is coming, leading indicators are telling us is coming. Market traditionally underestimates how much rates are going to fall once we get on the other side of this. And I think the last thing, again, you won't be able to see any of this, but we spent a lot of energy with the old capital team trying to come up with potential alternatives to what you've got, right? So in this particular example, and this will be in the slides you guys see, is essentially, hey, I have a cap that's deeply in the money, and I've got huge escrows that are being set aside. Is there a way for me to refinance that, kind of press the reset button on that stuff, get a higher strike cap, unlock those escrows, unlock the current mark to market on my cap, and kind of press the reset button on this financing? And so we spend a lot of time on stuff like this with the old capital team to say, hey, we're trying to give you guys alternatives out there because I know the cap escrows are killing people, right? Call them, right? They'll call us, we'll work together, we'll try to come up with some analysis. You guys can just make your own decisions. Like, I try not to make recommendations on stuff, I just try to show you the math. Say, here's the math for this particular thing. It's up to you to make the best decision for your business, okay? So let me press pause there and see what questions anybody has. I assume none, just to take off.
Pretty straightforward.
Pretty straightforward.
All right. Yeah.
So for all of us that bought caps, back in 2021, there was somebody on the other side of those transactions. Like, how come we haven't heard about the tale of woe of all these people lost all the money?
Yeah, it's a great question. That's not how cap traders view the cap that they sell you. Okay, so this is a little bit caps 201, but the way that they view when they sell you the cap is you are just influencing their overall position on that particular trading day. And if you're buying a 3-year cap, let's say, they're only considering how much did you change their 3-year bucket. They don't actually care about your individual cap. And so they then go out and hedge that risk with some other provider, and they're only hedging the rate component of it. They're not hedging your counterparty risk. So from that trader's perspective, you just got them longer, a 3-year cap. They're like, okay, now I'm gonna go get shorter, the 3-year cap, balance myself out, get back to my neutral position. They do this all day long, thousands of trades, billions of dollars, and then on top of all of that, and this is really important to remember from 08, because swaps and caps behaved very well in the financial crisis. Credit default swaps did not. That's because they were not collateralized. Credit default swaps had no collateral backing them. Interest rate derivatives were backed by collateral. At the end of each trading day, just like today, banks who had been trading with each other settle up. And they say, you know what, I net added 50 million in exposure to you. You got to send me 50 million in treasuries. And the bank says, you got it. And they send it over. And they're legally obligated to do that. So those providers, they view it as just being like the middleman. They want to charge you a little bit of markup. If the cap costs you 100 grand, it probably costs them 90 grand to hedge it. They're trying to make the 10 grand. They're not wearing that risk for the next 3 years the way that you guys are. You look at it as like a 3-year instrument. They look at it as, this just falls into my 3-year bucket. I can change my position 10 seconds from now. And they just take the other side. And all they're doing is trying to measure or manage that mark-to-market number, unlike SVB, right? And so they manage that all day long, and that's what traders do, is try to manage that risk, keep themselves at a neutral position. Does this mean you have a question because you're grabbing the clicker?
Yeah. What was this discount window
So they're coming to get the money. This is to back all the treasuries. You think at the discount window? So I bought 150 billion of treasuries, or SVB had whatever they had. Now I'm just going to go get the money from the Fed and just get it at par and just hold the money on my balance sheet now as a loan.
Probably not doing it all. They're probably doing the amount that they would need to signal to the market that they've got enough cash to remain liquid. So for example, if they had lost 40 billion in deposits, they might try to offset that by using this. So they would take 40 billion in treasuries to the window. They'd say, here you go, give me 40 billion in cash back. And the federal government would say, you got it. I'm gonna give you 100 cents on the dollar for this, even though it's only worth 80. I'm gonna give you 100 cents on the dollar. And now you have cash to support that withdrawal that you just took down.
Is there a way to see who took that money out of the window?
Yeah. Yeah, they have to report it.
We'll send that out later. Because the question that I was getting this week was, all right, how do I look at, besides like the top 4 or 5 banks who have over $1 trillion, who are systemically important, everybody else is below that. They've got not only their personal money, but they have their property money there, they have all their escrow accounts there. How do I know the bank's gonna be good?
Yep. And Yellen did not help that today, because while Powell's talking, she's testifying to Congress, telling Congress, hey, we're actually not going to backstop deposits across all banks. I was like, well, wait a minute, you just said the last 2 weeks, like, that's exactly what you were doing. Now you're saying that you're not going to be doing that? And it just created all this uncertainty. I think what she was probably trying to say was, we're not going to do it forever. But the market just took it as, well, if it's not forever, then when's the cutoff? Is it tomorrow? Because that changes my mind, right? So they're just stuck in this really nasty spot where, to your point with like depositors, it's totally unrealistic for 250 grand to be the number. That just doesn't make sense, especially if you're running a business. Like that's nothing in payroll. But they're also trying to balance the moral hazard of saying there are no downside risks. I personally think depositors are totally different than shareholders. Shareholders, that's part of the game. You stand to get wiped out. Putting your money in there to run a business, I don't think those people should have been at risk to get wiped out at SVB or any other institution.
All right, I gave you a little time. All right, here we go.
Should I say that I'm really glad that your Super Bowl depression is through it? So I've seen a lot of articles recently where like they're kind of pushing Powell to go 2% is not really achievable based on the sticky inflation, and maybe they'll just go to 3. So all of a sudden they adopt 3, then what does it do to all this wonderful fun stuff?
It's like my kids changing the goalposts on like the GPA target I give them. They're like, 3%, 3.0 wasn't reasonable, Dad. Can you live with 2.5? And the answer is like, of course, whatever gets you off the payroll. I don't care what your GPA is, just get off my payroll. So the question is about the 2% target. So the first thing I would say is the reason that the Fed wants some inflation is because if you have no inflation, I asked this question when I interview people to come work at Pensford. I'm like, why does the Fed want there to be some inflation? Why not just make everything zero? Or better yet, why not make it cheaper in the future? And the reason is, if you think something's going to cost less in the future, you're going to hold off on buying it, right? Well, then that impacts spending, that impacts GDP, and we actually slow down, we have a recession. So they want enough of a catalyst to prompt you to buy something because it's going to be a little bit more expensive in the future. And the idea is it's something stable, 2%, price stability. That's what you hear them call inflation, price stability, right? The thing about this 2% number is totally made up. There's actually literally no evidence to suggest that 2% is the right number. And so I think it was the New Zealand central bank chief from the 1990s came out a couple weeks ago and was like joking about it and said, I made an off-the-cuff remark once in the mid-1990s and it went viral before that was a thing, and all of a sudden everybody was saying 2% is the number. It was off the cuff. I made it up. I have no academic research to back this number up. I just said 2% and that became the thing. And that's all that they're using now. So the question is, are they going to change that number? And I would say no, because of the credibility issue, right? If they change that number, it's going to be over a long period of time. It won't be anytime soon. They won't just throw in the towel and say, we changed our mind. 2%'s made up, let's go with 3. Even though they could probably make an argument that 3% is the right number. That'll just take a while. So I would say, I would not expect them to change the goalposts anytime soon because it would be the markets would be all over them. And they have enough credibility issues. They're not going to pile on themselves by doing that. I think what they would probably instead say is, it takes a while to go from 3 to 2, as opposed to we're going to keep hiking until we get to 2. It's like, we got close enough, now we're just going to kind of ease our way into 2. That's what I think would happen.
My question here is related to rate caps. We purchased 3-year rate caps, which is pretty great, back in 2021, so those don't expire till well into the second half of 2024. And like as recently as a month ago, these were worth like $500,000.
Are you just rubbing this in everybody's face?
No, I'm sorry. The question I'm trying to get to is that now it's tempting to kind of sell it just like a stock.
Yep.
It's like stock option, get that $500K, because I think my mortgage has only gone up by maybe the 30 or 40K. I can kind of hedge that bet, reserve the money that I've been getting as reimbursement, assuming a max interest rate hike of today plus another 0.5%, pause, plan for 12 months. Am I better off doing that versus?
Yeah, so.
Because it's going to be worth less than 3-4 months if rate hikes pause or come down.
Definitely. Is it a required cap?
Lender required?
Yeah.
Yes.
Yes.
So,
So what you could do is sell it, you could sell it, but maybe recast the cap,
Yep.
maybe?
yep.
Good.
So if it's required, you have less flexibility than if it was just totally optional. But a lot of times you can recast it with lender approval. And so you could go to them and say, I've had NOI growth up, 20% or whatever. Therefore, I should be able to set the strike at XYZ that would back into a 125 DSCR, and therefore allow me to do that. Or my business plan has changed. I'm selling this thing a year from now. I got 2 years left on this cap. Can I want the last year of it? Right? And they might agree to that. So I think your thought process is right. I would definitely be exploring it and see what the lender says, because I agree. If they pause, 6 months from now, that cap is going to lose a ton of value. Right? So in a perfect world, you'd be selling it now and buying another one 6 to 12 months from now.
Thank you.
Any other questions out there?
So you mentioned the banks are in a better position today than they were in 08. How much of that is due to not marking like their hold to maturity assets down to actual par value or current value right now? Like, do you have any insight into that and how that's being manipulated right now on the balance sheets?
Other than none of them are doing it, I don't have a ton of insight. What I would say is that they're still US Treasuries, right? Like, they don't have default risk, which is what we were dealing with in 08. 08 was a house of cards because all the loans themselves were bad. The US Treasury holdings that they haven't marked down and taken the loss like they should have, but they're not going to default, right? So it's totally different than 08, because in 08 was like, oh, these loans actually are never going to perform. These people are never going to pay this back. And it's like set off a domino and just ran through the system very quickly. I think this time is they should have been taking the losses all along. They weren't. People are running the math saying you're going to be upside down. So what do you do now? And the Fed had to bail them out and say, you know what, don't sell. Don't recognize those losses. Give it to us as collateral and give you cash back. So I think the Fed has done a good job of trying to backstop that and stop the contagion. To me, having those Treasury holdings lose in value is not the same thing as having $40 billion in non-performing loans.
Like a true bad loan.
Exactly.
And then I have a second question. This might be better for Old Capital, but
Probably.
how does the underwriting for even agency debt change in, let's call it an 08 scenario, like a really bad recession? Like, do they start to get more conservative, or do they stick with the 125, 130, 75?
Fritz?
I would say the agency lenders are, HUD and FHA is the same way, but they see themselves as countercyclical to some degree, so they're very programmatic, which is why the agencies were not as competitive in 2022 as the other bridge lenders, because they stuck to their lending standards. And so, as we look at deals here in 2023, it's kind of business as usual. As long as you're at a 125 coverage, they're continuing to provide liquidity into the multi-line market.
One thing I'll add that I heard a lot this week was agencies, have roughly, I think it's $70 billion in allocations each one this year. They're very reluctant to come up short of that number because they're afraid that Congress is gonna ratchet it down next year. So the minute they don't get to 70, they only get to 55 or something. Congress says, no, you didn't need it. We're gonna pull you back down to 55, right? So the idea is at some point here, they're so far behind schedule, they will start pulling levers to make their deals more attractive because they want to hit that number. Now, they'll still be mission focused, they'll have those different initiatives that they're after. But and I said to this one gentleman, I was like, well, how long before they start pulling those levers? And he said, pretty soon. They're so far behind schedule that they're going to start pulling those levers now to change pricing, change the underwriting standards, because they're just not lending. They're going to come up way short.
Thank you. Thanks for coming. And I remember listening to a podcast recently that you hosted with Becker and Paul. Becker and Paul.
I try not to remember that one.
and I think there was one comment that says, I don't know what's going on, but I feel like something is perking. And we had the SUV, so I thought that was really interesting.
Who said that?
I think it was Becker.
Me? Oh, yeah.
It might be you.
Yeah, it was definitely me.
The question here, though, thank you for showing this data. You mentioned a point where, like, the next data that comes out, if banks borrow more than that 160 million point, we should expect something to happen. What do you think will happen? How will we hedge against that? Is it still survive to 25? Or is it
Yeah, I don't know that you can hedge against that, and I don't know that something else happens. To me, it's a signal that we do have continued weakness in the banking sector. If that number plunges, it's like, okay, they just needed to take some just in case. They were just shoring up their balance sheet just in case. The run on the banks are kind of past, everything's calming down, it's okay, right? If it stays elevated or keeps climbing, it makes me think it's actually getting worse. And that would be a bad signal. And if that number comes out tomorrow higher, it's like, oh, what's going on behind the scenes that we don't even know about?
It was definitely me that said that.
Yeah, I know.
So I saw a headline.
You don't even have a question, you just wanted to stand up.
I saw a headline the other day that the Federal Home Loan Bank issues $304 billion in weekly banks to boost banks' liquidity, and the system is known as a lender of next to last resort for banks. So if you know any, I don't really know much about the Federal Home Loan Bank. Do you know anything about that? It didn't sound good when I saw that headline. So.
It sounds like it's, so this number is only 160, we might be talking about the same number. The grand total of borrowing was over 300 billion in 1 week. And it's just, they have three different programs within the discount window, and so that may be one of those three programs.
Any other questions for JP? All right, Charles, just stand up, yell it out.
Okay, how are you stupid? But if I were a bank and I were holding 30 years or whatever, they're at half price. And I can walk over to the window and get full price for them. Why in God's name wouldn't I take everyone I can take, go over there and get them, and then buy some others at half price?
Yeah, I suspect that
So
that's
it looks to me like that number ought to be really high for a while.
It might be. But why would you sell them at half price if you can just hand them to the Fed and get
So that's
full
what I'm
par?
saying. I hand them to the Fed, get my full price, walk over, buy them at half price.
Who are you
No
buying
one's
them?
selling.
Who are you
No one's
buying
selling.
them for half price from?
Well, anybody who has them,
Well, they're posting it there too.
not if they're individuals, I mean,
Oh.
I can go out and go for market.
Oh, sure, yeah. But I would
It may not
think,
be as many and as plentiful, but I can.
yeah. So and they might be managing it that way. I suspect that they are not going to go buy long duration bonds after having just posted them as collateral. That instead they're like, you know what, we gotta be much better at our risk management strategies, and we should be investing, things that are backed by deposits should be very short term in duration.
Silicon Valley Bank got most of the headlines when they closed shop. Signature Bank also closed up shop, and that was, if you look at their loan book, it was primarily New York commercial real estate. I'm not sure what caused the run, but is it tied to kind of real estate defaults or mark to market on some of the real estate assets that they lent on, and then could that then potentially translate into other regional banks that have, CRE exposure?
So far, the run on the banks has been largely related to Treasury holdings. I think, how does this not extend to commercial real estate? Treasuries are they just happen to be an incredibly interest rate sensitive asset. Guess what else is incredibly interest rate sensitive? And Powell went out of his way today to say, no, commercial real estate is not a risk. Think of that, this is fine. I mean, I remember a lot of Fed officials saying a lot of the same stuff in 08. It was like, that would not be true. It makes me think real estate's like next up to bat. It started with Treasuries, and now it's just gonna work its way down. And just let me go find the next interest rate sensitive thing and see, have you guys been marking this down? Oh, guess what? Nobody has marked down commercial real estate because they don't want to. And they weren't forced to. What happens when you do, right? So I happen to think that might be the next thing that drops.
On Signature, they had a portfolio of New York stuff, and then there's another bank, and that other bank basically took all their deposits. Signature Bank, they didn't take any of the loans. They didn't want them.
Yeah. What about would that affect these weaker markets of San Francisco, New York City, Chicago, people where there's a decrease in population growth? Whereas, you go to the South and Sunshine States, and everything is going great guns, so, does that have an effect on it? Or is this gonna be across the board,
Now, Leo, this is your question to ask.
Oh, no, well, hell, my question isn't that complicated, really, is this. But anyways, I was just curious.
One question, I always have to ask you one question.
It may be for the next seminar we get together.
All right.
But does that have an effect on it?
I think basically what you're getting at is 2008 basically impacted everybody.
Yeah.
And I would suspect this time around is way more targeted. Like, I just have a tough time seeing Dallas struggling the same way that San Francisco struggled. Now, Dallas will never be as good as Philadelphia will, obviously.
Thank you, JP. Appreciate you coming out.